Hi, welcome everybody. I'm Lisa Abramowicz, and welcome to what I think is going to be completely objectively the best panel of the entire Milken Institute conference. We are talking about the hottest topic, which is the credit cycle, where we are, where we have been, where we are going. And we are speaking with some of the biggest luminaries in this field who have extensive knowledge, and also extensive knowledge, not just about the credit field, but about one another. So it will promise to be an interesting panel. Let's start by introducing them and getting them started. Glenn August joining us, Chief Executive Officer and co-founder of Oak Hill Advisors. He's got 33 years in the business, talking about distress, talking about all sorts of different financing solutions, with a assets under management of about $45 billion. Amy McGarrity, Chief Investment Officer of Colorado Public Employees Retirement System, with a significant portion of the assets managed in-house, more than $50 billion of assets under management. Don Mullen. He is the founder and chief executive officer of Pretium. He was a partner at Goldman Sachs, where he was on the management committee, and head of the security division's global credit and mortgage business until 2012, when he founded the company. And Justin Slackey, also a Goldman Sachs alum. He had been the head of the distressed bond business in New York, among other duties at Goldman Sachs, before becoming the chief investment officer of Shankman Capital, where he joined in 2011. Welcome to all of you, both on the panel and watching. I want to kick off this discussion with a very simple question, which is, where are we currently in the credit cycle? And I want to start with Don, because you had some pretty interesting thoughts on this. Don.
Well, thank you, Lisa. And I'm not sure I was as interesting as you otherwise implied, but I would say that the recession is just beginning, has sort of been my view about where we are. The opportunity set, though, is of this credit cycle is quite different than other ones. I'd characterize it as the volume of stimulus that we put into the economy was so extraordinary, not like anything we saw during the GFC, that instead we're in a moment that the credit cycle is just beginning. The financial cycle has just ended. And with stimulus put off, I think we'll see the opportunity for better credit investing than we've seen in quite some time. However, this will not be as sectoral driven, but rather it'll be really dependent upon security selection and credit selection in a way that we probably haven't seen since the early 21st century. And quite frankly, I think that really creates an opportunity for my colleagues on the panel and my team in a way that hasn't been present for any credit investor for certainly at least a decade, as I implied, if not 20 years. We led up to this cycle in a process that reminds me, quite frankly, of the lead up to the global financial crisis in this sense. We went through a decade of demand for floating rate product that caused global liquidity to come to the U.S. credit markets in search of yield, and that reduced credit quality underwriting for bank loans in particular. It manifested itself in CLOs, which in a robotic way invest in the marketplace and draw cold comfort, in my opinion, from diversification, similar to what we did with subprime mortgages. I can't help but remember all the things that led up from in my mortgage experience to that financial crisis, where the entire planet thought the safest place to invest was U.S. mortgages, and they did it through structured products as a way to mitigate their lack of specific knowledge. And I feel that CLOs have been that tool in this cycle. And so my expectation is that the challenges we'll see in the coming year will be predominantly bank debt, as we're forced to confront the poor underwriting standards that CLOs enabled us to execute upon, and that the opportunity for investing will be in weakened bank debt names as well as structured credit.
All right. Justin, do you agree?
I think that clearly the business cycle has been disrupted by the amount of liquidity that Don talked about entering the market through the backstop that the Fed provided. Just this year, only in high yield, we've issued over $350 billion of new issuance. That's a record. And if you compare that to last year, which was about $270 billion in a benign market, it just gives you a sense for year to date how much new issuance has come to market. And what that's done is it's delayed and deferred the opportunity for distressed. If you looked at today's market, we're now at about a default rate of 6%. That compares to 2.2% over the last 5 years. And of that 6%, 45% is oil and gas, 6% is retail. So the vast majority of the distress we've seen today are weak companies with weak balance sheets. Those are really challenging investments to make money on over the long term. So I do agree with Don that it's the forward where the distressed opportunity is going to be. However, it's likely to be very different than 02 and 08, where we saw an avalanche of bankruptcies all happen at the same time. And it really was more about getting invested at the right time rather than the name you picked. Whereas this time around, given the liquidity that's entered the market, what liquidity has done is it's delayed outcomes, but it hasn't necessarily totally changed the outcomes. And so as we go quarter by quarter, we think we're likely to see elevated default rates over the next couple of years, given that we have re-leveraged corporate America right at a period of time when there are more unknowns and unstabilizing factors in the economy than we've seen in a long time. So we do think the opportunity set for more volatility is going to be here today, and the opportunity for more distressed opportunities will be over the coming quarters, which will have to be much more surgical-like in the way you invest than more broad-based as we were in the last two cycles. I think you're already seeing that, just to give you a sense, already in today's market, where we're seeing significant bifurcation of returns. Just this year, double Bs are up over 4%, while triple Cs are down 7% year to date. That type of performance could continue for some period of time.
So Amy, come on in here, because if the scenario is Justin and Don are portraying it as accurate, then the opportunity will be better later on, which means that the opportunity right now might not be so great, relatively speaking. As someone who has to create a return for your members, how do you position?
Thanks, Lisa. Yeah, I think I first of all would agree with Don and Justin on their comments on where we think we are in the cycle overall. So within our portfolio, we have an active core bond portfolio that's completely managed internally. And the objective of that portfolio is really to provide liquidity and downside protection. So within that team, they do believe there are opportunities in the market. And like Don said, it's really security dependent. And so security selection is very important now, maybe more important than it has been in a long time. So the team is really looking, issuer by issuer in order to achieve the returns that we need within that portfolio. We also have an area of the portfolio that's more opportunistic in nature, which may employ managers that are able to act on dislocations in the market, whether it's in securitized product or other areas, direct lending, et cetera. And so that team is really charged with looking at the overall opportunity set and seeing where we are in the cycle. And so their view is similar to Don and Justin in that, there are opportunistic managers raising funds now. There's a lot of capital on the sidelines ready to go, but there may be a risk of getting in a little too soon. It seems that the cycle is a little bit extended because of the significant intervention by the Fed. And so sort of waiting patiently and trying to be selective on the managers we're allocating to within that opportunistic bucket.
So Glenn, I left you for last for a reason, and it's because we were talking about the current scenario and where we are in the credit cycle. You said that one of the distinctions between the 2008 crisis and today is the type of debt that's at the epicenter. So I'd love you to give a sense, first of all, whether you agree with the panelists about where we are in the credit cycle, which is we are not at the beginning of a new bull market in credit, at least according to the panelists, but also to give a sense of the differences between this crisis and the one in 2008.
So thank you, Lisa. I have lots of thoughts. So I think the notion that we're at the beginning of a credit cycle doesn't make a lot of sense to me. We were at the tail end for a 10-year run in credit, and then COVID hit. And the Fed stepped in, the Congress stepped in, and the world recovered. And so there's some amusement to me a little bit on the assessment thus far, and I agree with lots of things that were said in terms of credit selection. But if you look at your screens, the equity market is near all-time highs. High yield market's back to 5%. Loans are at 5.5%, 6%. And we're all just waiting to see what happens with COVID. We're waiting to see what happens with the election. And we're waiting to see whether or not we come out of this shock. And the equity market is saying that we're going to. And the credit markets are saying we're going to. And so to me, the question is, how does one think about credit today versus 6 months ago? Because there's a great opportunity for sure, just like there was in the equity markets when COVID the onset of COVID, and many of us were extremely active in buying first high quality, then stressed, and then a little bit deeper distress in COVID names. But as Justin said, there's not a lot out there, and there's an open question: are we going to see a lot more in the immediate future? And it's not clear to me that we are. There's certainly, and I would agree with Don, that there was a lessening of underwriting standards. There's certainly sectors that are COVID affected, where the jury's out. I mean, movie theaters. You have both the COVID effect and you have secular issues. The travel and leisure sector, again, if we come out of COVID, that will recover, but there's obviously lots of challenges. And so to cut to the short of it, I think where we sit right now is high yield credit, leverage loan credit is fairly priced to perhaps even a little bit overvalued because the absolute yield is so low and it's predicated on rates staying low. And again, I'll come back to demand field in a second, where we see the distressed market is very specific. There's obviously some things we can talk about later in energy and COVID names. And actually where we're seeing the most opportunity today is in private credit, in rescue financing, and some thematic opportunities in some sectors that have been stressed. So that's kind of what I'd say. I know I've gone on for a long time. My headline on '08 versus today is corporate credit in '08 was really a very leveraged asset class where people were buying loans in high yield on leverage. And when the market fell out, there was a margin call and forced selling. This time that did not happen. And it didn't happen because the bank debt was in CLOs without mark to market and people didn't have the margin trade on in size and high yield. And so there's a much more orderly recovery. And obviously when the Fed stepped in, it made a big difference. So that's some headlines for now.
Justin, do you agree that the leverage wasn't necessarily so much in the corporate credit side of things this time around?
I think coming into this, our view had been, we were reading for many years about how high yield was on the precipice of the end of a cycle. And we actually had the opposite view. We thought that given where rates were, companies were actually being pretty thoughtful about the amount of leverage they were taking. However, when you went through COVID, no company thought, hey, I wonder if I add this much debt, what is my leverage ratio? It was, I need liquidity, let me get as much liquidity as I can. And therefore, leverage has ticked up much more significantly than where we were previously. So I think that's why we're in a position today, which is much different actually than the last couple of years, because we're in a more levered position across much of corporate America. Go ahead, Glenn.
Yeah, I just want to make the point. Yeah, what I was saying was actually that not leverage in deals, because there's clearly a ton of leverage in deals, and now off of trailing cash flows, the leverage is up dramatically. What I was saying is that in 2008, a lot of investors were buying high yield using margin to own those assets. We're doing bank loan debt on total return swaps that had mark-to-market provisions. And so when Lehman fell apart, there was a margin call and people were forced to unwind those trades. This time, people did not have bank loan total return swaps on. Instead, the bank loan investments were made in CLOs. And in CLOs, there's not a mark-to-market provision. And so there was not forced selling this time unlike 2008. And in real estate, there has been some of that disconnect, and we can cover that later.
Okay,
Yeah,
we will get to the real estate.
Yeah.
Go ahead, Don. Yes, I was actually going to go to you. Go ahead.
Good. I would be more expansive in Glenn's comment. I think there's much less systemic risk in this system this time than last time. And that's what you've seen. That's why the financial component of the recovery was so quick. I wouldn't say where we are is singularly the product of Fed alone. I think we need to include the fiscal stimulus that was so extraordinary, multiple times larger than anything's ever been done in any recession, and its impact on consumer spending, as well as liquidity that went into the equity market from that by the increased savings rate, has really changed the way we look at an economy and financial markets post a shock to the system, as well as changing consumer habits. And so when I think about why it's the beginning of a credit cycle, which from my sort of perhaps ghoulish view, I think the beginning of a credit cycle is when distress happens, not the rally, because I think distressed is the most fun part of the product, right? That right now, this shift in consumer preferences is so powerful that we're going to see a very significant default cycle, as Justin talked about. But as all three of us have agreed, it's really going to be much more security specific and company specific and not industry specific, which Glenn said. So in the past, yes, we avoided energy and you tended to outperform versus guys who bought energy. But in this case, you didn't want to avoid all retailers because some retailers had great outperformance in this cycle while others completely collapsed. And so I believe that combination of credit selection and security selection I mentioned, because we're doing so much priming of legacy lenders in this cycle as people try to pile on debt to increase their liquidity, as Justin mentioned, that we're really sort of, in many cases, driving over the dead bodies of former lenders to make sure this company survives until we figure out where consumer preference lands.
Driving over the dead bodies of lenders. I just want to let that register. I'm going to get to you, Justin, in 1 second. But Amy, I just want to bring you in here because there is a question. If this backdrop is accurate, if this is correct, that we are at the beginning of a credit cycle, as Don would describe it, which is the beginning of the distress, because that's the fun part, how do you remain nimble while you pick credits while also delivering returns that meet your bogeys?
Sure. So in essence, the fixed income portfolio, the credit side of the portfolio is doing that security selection and really being selective on what they're being exposed to. So I agree with Don in that, I think the fiscal stimulus, in addition to the monetary policy, has been extraordinary on the consumer side, as well as you can think of specific sectors. I know that my esteemed panelists are talking about it's not sectoral based, but if you think about the airlines and the supply chain there, and the significant disruption they have experienced, a lot of the supply chain, those industrial companies immediately, exhausted their revolvers, et cetera. I don't know how long that can go on, depending on, COVID and how it evolves and unravels over the coming months. I think we'll see some real distress there. And so our team continues to, look credit by credit and bottom up security selection in order to achieve those returns. And then in the opportunistic side of the portfolio, we're going to be looking at managers just like the three on the screen with me to deliver those more opportunistic returns.
All right. So that was a great plug for all of you. Justin, do you want to come in and say what you were going to say?
Sure. I think that when we think about the returns that Amy was just talking about and where we can achieve them, one of the things to really think about is that the construction of each of these markets, the characteristics, are very different today than we were in 08. And so we tend to think about markets broadly and we talk about them as one asset class, but they're very different. For instance, if you look at high yield today, given the over $200 billion of downgrades that we've seen from investment grade, high yield has gone to 57% of the asset class is now double B. If you compare that to 2008, only 40% of the asset class is double B. And so perversely, as we've gotten more downgrades, the asset class has gotten a lot safer. And so you, in theory, should see spreads be tighter during a period of time where you've seen double Bs grow as such a high percentage of the overall asset class. Now let's compare that to the bank debt, the investment grade market, where in 2008, 32% of the investment grade market was triple B. Today, as many people in this audience I think know, over 50% of investment grade is triple B. But what's more interesting is coming into this year, $160 billion of debt was low triple B. Today, we have double that amount. So the investment grade market has become much more concerning where we are today versus where we were in 2008. And I think as investors think about how they've allocated capital, where they've gone defensive, going up the cap stack, going less levered in investment grade, the perspective of how they think about what that return profile will be going forward is likely to change. And in an environment like we're all talking about, where there's an enormous number of unknowns, those unknowns are likely to create more periods of intermittent volatility. And as that volatility hits, markets that are structured differently today will react differently than they did in 08. And I think it's important that investors think about how to allocate their capital with that as a backdrop.
Justin, I think a lot of people would make that same argument, and they would argue also that the Fed intervention gives a backstop to high yield bonds. But given the fact that spreads right now, I believe, are an average 4.6 percentage points over benchmark rates, even if you do get more spread compression, you're not getting that much. And it goes to, Glenn, your point, which is that you see the big opportunity in private debt and rescue financings. How do you go about sourcing that? How much competition is there? Because it seems like that market is also getting pretty crowded. So where are the opportunities?
So I think private credit is, again, the most interesting opportunity today. There are really two legs to private credit that we focus on. There's a third leg we don't focus on as much. The two legs we focus on are rescue financing and liquidity financing to really deal with the companies that are dealing with the COVID challenge and have liquidity challenges. And they tapped out their bank lines. They've tapped the markets where they can, but in many cases, they are looking for additional financing. And so we, in terms of sourcing that, and we believe that opportunity is probably an 8 to 12% type of unlevered return opportunity. And we think that's very, very good value because you have the opportunity to go inside to companies, understanding where exactly you're lending, get certain collateral in some cases. And we like that a lot, and think that there's a good opportunity, and that opportunity will continue. It was extraordinary coming in March, April, May. It's probably rallied a little bit since then. You probably could have done investing at 12, 13, 14, and now today it's probably closer to 10. But we think that's a very good opportunity. Secondly, there is an enormous amount of private equity that is yet to be deployed. And while COVID has certainly slowed down initially new transactions, there's clearly a lot of new transaction volume. And a lot of private equity sponsors have decided that the best financing approach for larger deals, not smaller ones, is to actually do a combination of a large bank deal that they sell to the CLO community, as Don said, where there's a lot of diversification and ratings are super important. And then they add a second lien tranche at the 40, 50, 55% loan to value. And that tranche is customized to provide both the sponsor and the investor with a pretty good investment opportunity that is helping the sponsor leverage their transaction in a way that gives them what they need in terms of asset sales and an opportunity to improve the business, but also gives the investor, we think, a very attractive return. So we like that a lot. We have an extraordinary collection of relationships that have been built over 30 years. And we actually think, like, when I start talking about this a little bit, I go into, and Don and Justin and I have been friends and colleagues for a long time and have really watched the evolution of the leveraged finance market. But it used to be a bank loan high yield market, and there wasn't private finance for large deals. But as deals got larger, as pools of capital like ours and Don's and Justin's and others got larger, the ability to execute on a customized basis became more real. And so we think the trend in leverage finance is to do more direct transactions where it's customized capital structures And we think that tranche of the 50% layer is exceptionally attractive. And if I may just say one more thing, Lisa, again, I like distressed a lot. Okay, I've been doing distressed for 30 plus years, and it is some of our best investing in our history. And I wish I was as bullish, if you will, on Don and Justin's view that distressed is around the corner. But the market's not telling us that. I mean, I and we all do listen to what the market says. And the market's saying that equities are at all-time highs, that high-yield bonds are at 5%, that loans are at 5.5%, that the distress ratio is at 10%, but it's predominantly energy. And there's plenty of liquidity around to provide rescue financing, that I don't think this default cycle is around the corner unless we are on the verge of a major recession. And I suspect post-election we're going to get stimulus. And I suspect the Fed is going to continue to be supportive. And so I love distressed. I love workouts. We've done 15 plus billion of them over 30 years. But I don't see it. And I actually disagree with Don, again, sorry, Don, on that this is not about sectors. Okay, because there are sectors in deep distress. There are sectors facing secular change and have cyclical and secular change. And so I think that's where the opportunity sets are going to be. Of course, I do agree that it's all about credit selection, but I think that as much as I wish there were a distress cycle for our investors to capitalize and generate those returns right now, this minute I don't see it. And that's my take.
Don, I will let you respond if you would like.
Sure. Well, there's a whole bunch of stuff to respond to. I'll do my best. First, I'll start with Justin's comment, which is I'd like to amplify what he said, that there's been a big change in market structure. I think Glenn effectively alluded to that or directly addressed it. The combination is not just private, it's passive, larger and larger managers, the expansion of private credit, like Glenn talked about, the steady increase in transparency, and the growth of CLOs, all have made this market different than the market of 2001 or 2008 by quite a large margin, in our opinion. Within Glenn's comments, and I'll come back a little bit at something, it may not look as attractive for him because, God bless him, he's built a very large money management firm. I think the opportunity set may play better to the mid-sized, more nimble firm who's in a position that going out and buying a modest amount of a pet retailer, which was thrown out like the baby with the bathwater in the proverbial story, because people didn't want to own retail. And you could buy those and make 20 or 30 points on them. I think there's been a lot of view that sector can be a way to diffuse risk, but in doing so over the course of the last 6 months created opportunity for people to invest in what is perceived as stressed sectors, but you're buying non-stressed names. And I think that
Don, do you see that? Do you see that today? Because that was a great trade, okay? But do you see that today? And it's not there today. And by the way, I'd like to think.
I guess my point is go back to your travel and leisure comment. I think there will be winners inside travel and leisure, but we're going to see continued problems inside that sector. So when I look at it, I don't see a specific name I'd say, let's buy this today. I'm not going to go on CNBC and say, here's the 3 names that we should buy. But we are seeing a radical change in consumer preference in a way that will create investment opportunities. And that will be, I don't imagine us getting the airline industry, as Amy suggested, back up to 90% of 2019 within 24 to 36 months. But that's the amount of liquidity these companies have raised. So we're going to see a very significant restructuring of that whole supply chain. But as you pointed out, it'll be movies, travel and leisure, restaurants, retailers. We're going to go through the list, and that will end up being a very large percent. We'll have dispersion, I think, is the key theme that we're talking about, but we're not directly addressing it. There's a whole sector of this market that's performing really well and will over the next 2 to 3 years. And then there's a whole part of the marketplace that was already under siege, retailers, that's going to have a problem as preference gets amplified by this crisis. And then in addition to that, there's further changes and how consumers spend their dollars going forward. So as a result, I'd see the opportunity where you're going to have great credits that are good yield plays with have very little risk, and you're going to have distressed at the same time. It reminds me to some degree of the housing market, which I'm also involved in, where I've never seen so many delinquencies concurrent with an incredibly large increase in demand for housing. That never happens in a recession. Never happened in any cycle before, where you're in a position home ownership's going up, demand for purchase mortgages are at an all-time high, people are refinancing, and we have the largest number of defaults since the GFC. I think credit's going to look like.
All right, Justin, I want you to weigh in because there seems to be an underlying dissonance here between Glenn and Don, and maybe there's some stories they can share later as well. But I'm wondering, Justin, whether part of this has to do with the big debate of, is it better right now to be a big private debt investor or a big debt, distressed debt investor versus a small one? The idea of having heft and being able to craft your terms in a bespoke deal with a single company, or the idea of being nimble and being able to take advantage of smaller dislocations within industries. Justin, what's your take?
Sure. I think it depends on where you are in the market environment to answer that question. If you took 02 and 08 as an example, the bigger you were, the better you were going to do, because you can control outcomes, you can get into bankruptcy, you can control the process, and you can turn that process towards your benefit. Today, we're not in that kind of environment. The distress are more stress, right? The distressed companies that are big are weak companies with weak balance sheets. If you have a lot of assets to put to work and you're a big manager, you're forced to buy and focus on those large capital structures. That's a challenging place to play. But where Don was talking about, which is more the stressed part of the market, which is the mid-sized companies, there are an enormous number of inefficiencies that have been built up in the credit markets, whether it be CLOs having to sell triple Cs or crossover names going from investment grade to high yield. There are a lot of specific opportunities that occur in these markets if you can be nimble, event-driven, and have an asset pool that's smaller in size where you can make a difference with those opportunities. That's really where you want to be from an opportunistic investing standpoint today. And that's the way you can make returns today. Now, if you're looking for more traditional high yield or towards what Glenn was talking about, where some of the biggest names maybe start to do privates among 3 or 5 large players, I think asset size is going to matter in traditional high yield, and you definitely want to have a larger asset pool to go after that. So I think really, for opportunistic investing today, small is better. I would also make one other comment on, because I think it's just really in the private debt part of the world, where we've obviously seen a dramatic growth in private debt over the last 5 years. It's likely to continue to grow. We do believe in today's environment, private debt seems to us to be a bit more challenged. All the things we've talked about are how many unknown situations there are today, whether it be COVID related or the speed at which unemployment comes back. And taking long-dated, illiquid risk in that type of environment seems challenged to us. We'd much rather be in more liquid vehicles where, as the environment evolves, you can adjust. Take the convertible market, where there's a lot of interesting rescue financings that have occurred, and we think that market will continue to grow, but also give you liquidity to move around. So as you think about how to get return profiles, to us, that's a much more attractive place to be than locking up your capital in companies where you really don't know how the macro economy is going to evolve, and the plates underneath you can shift even if your investment thesis is sound.
So, Justin, I'm going to let Glenn respond at a certain point, but before I do, because I'm sure you have endless things to say and are waiting, I want to get Amy, though, in here, and I want you to come in on the idea of how you pick external managers to work with and sort of weigh in on this big versus small debate that we're all having here.
No, it's a great question. So as we think about Colorado Para itself as an investment manager, You talked about how we manage over half of our assets internally. We're a medium-sized asset manager in the fixed income space. We manage over $11 billion internally. So we're really small in the fixed income space. It's a fragmented market, but it's pretty concentrated somewhat at the top. So relatively small, which we believe enables us to be more nimble, as my colleagues were talking about earlier. So we think that is an advantage for us, and we are finding relative value within sectors, within industries, and are able to capitalize on that within our portfolio. As we think about external managers, we have more strategic long-term relationships with managers that we believe offer value throughout the cycle. And so we'll continually re-up as they raise new funds, et cetera. And then we may have a view that there would be particular opportunistic managers that may have a particular style that could benefit in any given market environment. And so we would allocate to those on a more opportunistic basis. And so you find us during the crisis, re-upping with managers in more opportunistic funds than we would have historically. Due diligence right now is somewhat challenged in that we can't get on site necessarily to kick the tires, which is an important part of our overall process. So we've seen the team allocate to a more strategic manager in a more opportunistic fund during this period, because we know the manager, we trust their process, their team, and their overall philosophy. So that's kind of how we are thinking about it. And then one other area of the market where we are seeing opportunity within that opportunistic sleeve of the portfolio is real asset lending. We have exposure to most of the asset classes we've talked about today on this panel, but I don't know that we've really talked a lot about that. I don't know if my colleagues have experience on their teams doing that, but we felt like and feel like those assets, not only owning them, but also lending against them, provides some more stability and a real asset as collateral, and have really looked to that area of the market as well.
We'll get there, because I think everyone's mentioned mortgages and housing debt and the commercial mortgage situation, I'll call it, at some point. So we will get there. But before we get there, Glenn, I am going to give you your word. It seems like people are saying here on this panel, your colleagues, that being small is better in order to be nimble and be able to get some of these dislocations, and that way you're too big. And Justin even went so far as to say the lack of liquidity can be challenging at a time of distress, especially if you have to get involved in older companies that are grappling with perhaps burdened balance sheets. What's your response?
So it's really funny in that it's all in the company that you're meeting with. When I sit on panels that I'm sitting with people who manage $200 billion in credit, I talk about how Oak Hill at $45 billion is nimble. I think that's part of the discussion here today, with great respect and affection to my friends.
Throwing shade. Okay, go on.
I think that I have said, and again, been doing this for a very long time, I absolutely think that being nimble is incredibly important. And we certainly have worked over the 30-year period to be nimble and care about $25 and $50 million positions and navigate in and out of those on a regular basis. I also believe that having scale, and I'm proud and excited about being at a place where we have $45 billion of capital today, because I actually believe size matters. I think scale matters. I think relevance matters. And I think that in every aspect of what we do, I think in distress situations, having a large seat at the table to drive a process, to control a process, to lead a company through bankruptcy, to take control or a large position in a bankruptcy and go onto the board, to take it public, to choose the management team, all those things, size matters. To provide a sponsor who's doing a $2 billion private equity deal and is looking for a $500 million junior piece of paper to layer in between their equity and their bank loan debt where they get cheap financing, the ability to write that check matters. I disagree. Let me phrase differently. Illiquidity is all about getting paid for it. Everything we do, credit risk, liquidity risk, if you get paid for it, it's good. If you don't get paid for it, it's bad. I believe, and Justin and Don may disagree, that today in private credit, in large cap, you're getting paid 200-300 basis points of premium. And if you can actually do your work, and if you can really go deep dive into the company and feel comfortable with what you're doing, then that's good. So I think size really matters. And that being said, we have a $25 billion liquid credit business. And, my only view on the liquid credit markets is that today liquid markets are relatively fully priced. Now, again, I'm excited about distress, and I agree with Don and Justin that there's definitely opportunities, and we're doing a lot of stuff. I just look across the markets that we're involved in, and I think liquid markets today feel a bit fair to overvalued. I think illiquid markets feel a bit undervalued, and we're waiting for the distressed opportunities like Don and Justin are. So I think there's more agreement than perhaps I've articulated thus far, but I also think that size, scale, relevance in many respects means more today than ever, especially in a potentially uncertain market where people want to know that investors like us have the capital to close transactions. I think size really does matter.
So underpinning your comments is the question of whether you're getting paid to take the illiquidity risk. Don, weigh in. Do you think that you are getting paid sufficiently to take the liquidity risk, to go into something long-term that you cannot get out of versus the opportunity or the lack thereof that you're seeing in the liquid markets?
I think you can. I don't think it's a universal statement that you do. And I think Glenn and I are agreeing more than we're disagreeing, as he implied. But let me do a better job than I did last time of trying to describe it. I think what's happened over the course of the decade since the global financial crisis is we've generally seen a greater aggregation of assets and larger, very successful money managers. In addition to that, the role of the smaller money manager or the beta producer in the past has gone to passives. And in addition to that, we had, as I mentioned, the CLOs who are a bit more robotic in their investing. And as a result, you end up being in a position where mid-sized enterprises that may even be below the needs of Glenn's investment criteria in scale for his private credit business end up being these smaller companies that are orphaned and do have less liquidity. And they afford the opportunity for the nimble manager because they don't go to the threshold of being important enough to the scale of other money managers like Glenn and the bigger guys that he goes on panels with and then pretends that he's the smaller, nimble guy. Which is
Well
clearly with the backdrop he sits in with the pocket handkerchief, he's the most rakish nimble guy I've ever seen. But with that, I do believe you can get paid very well there. I think that's more the nature of the cycle we're going to see. I think there's a ton of capital raised for distressed, as Glenn mentioned, that's looking for that opportunity, but there's so much of it been raised that it does put pressure on returns, I believe, for larger distressed and stress names, and that you'll find more return and greater value in mid to smaller distress situations where you may be able to control them. I don't disagree with Glenn that control is always a good thing, but rather my point being market structure is giving you greater risk-adjusted return in mid to smaller situations.
Just quickly, just to clarify, Don, how much are you reserving in liquid assets to pounce on these opportunities that you expect? In other words, how do you remain nimble ahead of a distress cycle while not, avoiding or missing out on some of the gains that we've been seeing?
Well, I think we approached it the way Glenn suggested, is that we've been through a rotation from investing in IG early in this cycle to moving down to crossover, then moving down to high yield, and then rolling down to stressed. And what we've been doing since then is effectively feeding each of those sectors back into the market as we've seen the rally, and now very selectively looking at some of the smaller distress. So we didn't miss it. We just rolled with the market.
So, Justin, come in here on the liquidity debate. I'm sure that you have a pretty strong opinion on this, especially given what you were saying, that you are actually seeing more risk in private credit. So where are you seeing the risk that has not been illuminated in the discussion that we've been having so far?
So I actually agree with a lot of what Glenn laid out on the private debt. The point, though, is where are we in the cycle? In 2008, in early 2008, and Don will know this well, as I was working with him, we were in charge of a distress book. And early '08, we bought a number of distress names that we were really excited about. And we were getting 200 to 500 basis points more than the market to buy those names. And I think there was a really great thesis for those names. However, once Bear Stearns and Lehman went under, those names we had pre that event now became terrible. We had to work them out. We wasted time on them when the bigger opportunity set was something we could not yet see. And I think that's really maybe where the disconnect is between what Glenn's laid out on private debt and what we're thinking, which is where we sit today, we believe that the credit markets are more uncertain today than any time over the last decade. Between COVID, unemployment, the election, and the massive amount of stimulus, where we know what the short-term effects are, which is the elevation of all asset prices, but we don't know the medium-term impact. We don't know if it's going to lead to inflation or effect on rates. We're going to learn a lot more about all those unknowns over the next 12 to 18 months. And as those unknowns become known, that is when you're going to want to make sure that you can be nimble and event-driven. And I think that's really the difference.
But Justin, what do you say, what would you say to Glenn's point, which is there is such a flood of liquidity, whether it's in the form of private equity firms hoarding cash, or whether it's the Federal Reserve willing to step in, that will sort of deter this dislocation to the same degree that we saw back in 2008. What do you say to that, saying, well, that doesn't account for X, a big recession, or whatever else it may be that will cause the pain that a lot of people have been expecting?
Yeah, I think what I'd say is we just don't know. We know that there are more unknowns today. And whenever there are more unknowns, you want to be more diversified and more liquid so that as those things play out, you can react to them. The more locked up you get, the longer the investments, the more leverage you put on those investments, the less flexible you become when those events happen. Glenn may be right that the liquidity the government put in and all the PE sponsors means that even if unemployment stays elevated all throughout the year, we might not have any stress. Our view is that it will create volatility. It may not create this massive default wave, create significant moves in price. And in order to take advantage of that movement in price, you need to be more liquid and be able to be nimble during that period of time.
I want you to come on in here because there is a question underpinning all of these comments. What is the adequate returns expectation today versus 10 years ago when the interest rates are where they are? And given the fact that if you were to lower your bogeys, for example, you would have to ask for more contributions from taxpayers or reduce the benefits that you pay out. How are you adjusting your returns target given where we are?
So the way we look at our overall long-term return assumption is through an asset liability study that the board conducts every 4 to 5 years. And I won't get into the operational logistics behind it, but essentially we use the external consultants' return expectations to derive the overall strategic asset allocation. And that results in a long-term expected rate of return. So we completed that study in 2019 and essentially reiterated that we believe we can achieve 7.25% over the next 30 years. And certainly given our funded status, we need the near-term returns to be very strong in order to make it through a volatile period. So as you consider plans that are less funded than other plans, there is a significant cash requirement to pay benefits, et cetera. And so we believe we can achieve the 7.25 over a 30-year period. Now, certainly that was done in 2019, so the market has changed considerably. But because we have a very strategic view on strategic asset allocation, we don't time the market. We're not revisiting that on an interim period in order to readjust, because we do believe that over that 30-year period, we'll be able to achieve that. So we'll review the asset liability structure again in 4 to 5 years and see what the market expectations are at that time. I do think, though, that it is important to consider what each of the asset classes is there for, what is their purpose and their role. And I talked about it earlier. We look to fixed income, the core portfolio, which is that $11 billion. We're really looking to that to provide liquidity, downside protection, and diversification, which, as I look at the overall portfolio during March, that's what we needed it for. We were seeing out of balance relative to our overall asset allocation ranges, and so looked to fixed income to raise multiple billions of dollars to reallocate back into equities or to pay benefits, et cetera. And so that's why we have that core portfolio. We do believe there are opportunities that offer higher returns. Glenn talked about 8 to 12% returns. And that's what we do within the opportunistic bucket. And so we have exposure there, but each asset class plays a role. So while we do think that return expectations for core fixed income are low going forward, we have other areas of the portfolio that we expect to compensate for that lower return in exchange for diversification and liquidity of the core portfolio.
So let's shift to some of these other asset classes. Glenn, you talked about commercial mortgages. Is that where we're going to see 8 to 12% potential returns when the market crashes?
So I have to say, and you'll forgive me, I hope, Amy's comments that she just made are arguably the most important comments that have been made in this entire session. The fact that Amy is targeting a 7-8% return when 10-year treasuries are at 70 basis points and equities are at all-time highs explains why capital is getting allocated to opportunistic credit. And more capital is coming. And so the question for all of us on this panel on the investing side is, where do we allocate it? And where do you do it in liquid? Where do you do it in less liquid? And I think there will be a distress cycle, but there's some segments today, but it's not in the market today. That's just fact. In terms of the mortgage question in the real estate segment, I agree entirely with Amy, and I imagine with Don and probably Justin too, that there is and will be an incredible market opportunity in the real estate financing space. The fact of the dislocation in the combination of the financing markets being many of the mortgage REITs using repo financing for medium-term assets, and the forced selling that happened there in March, April, May, and will likely continue in some respects throughout the rest of this year, has really been an underscoring of mismatch, asset liability mismatch. Secondly, you have the secular issues in terms of where are we in hotels, where are we in retail, where are we in live entertainment venues. You have an enormous amount of leverage in the system. And again, I think that there is going to be retail is obviously under enormous pressure that has this combination of was already in secular decline, COVID hit, and now in further secular decline. Theaters, I mean, there is so much opportunity in our view that is coming in the real estate space. And we think it's early, and we think there's going to be a lot of it. So again, I think there will be many opportunities to do double digit, 10, 15, 20 plus, depending on where one chooses across the risk spectrum to play. But I think that's an exciting opportunity.
Before I let you go and move on, Glenn, though, are you already starting to buy, or is that opportunity yet to come? And the other side of this opportunity is the crash yet to come in commercial real estate?
Yeah, I think it is more yet to come. I think there were short-term financing forbearances that came. We did bid on a couple of rescue financings in connection with a couple of mortgage REITs and did not win them, and believed ultimately they were priced at levels that we were less excited about. But there is no doubt in my mind, absent an immediate recovery from COVID, you look at that this is going, that we're in the very early stages. And so we are building out our business. We're doing an enormous amount of work to be ready to seize on the opportunity.
Don, I'd love you to weigh in. Are you in agreement with Glenn here?
Yeah, I agree with him. I would focus our attention in the near term on residential credit risk. That's already taking place. We had a forbearance program put in place by the federal government that allowed a large number of Americans to not make payments on their mortgages. And as a result, we have non-payment at the highest level since the GFC, one of the highest levels in U.S. history, up there with the three great moments of the GFC and the Great Depression. I don't think all of those people will be in a position where they permanently don't make payments. But that's occurring at a moment in time where we have a record amount of equity in the US housing sector. So, unlike the period of the global financial crisis, where we were in a position that many mortgages were upside down, meaning there was no equity underpinning them because there were house price declines that were so severe, we're in a position today that most Americans have a 2 or 3 times the amount of equity in their homes. And so as a result, I don't expect a process that will be downward pressure on house prices as it was last time. That combined with the supply demand imbalance we've experienced for a decade still persisting because COVID made that preference for single family homes. So as a result, I think it's about dispersion again, where we're going to have distressed and high performance concurrently and create an extraordinary investment opportunity. And yes, we've already been investing in that sector and purchasing distressed mortgages. And I agree with Glenn that it's early, not late in the commercial real estate cycle, but we will have a tremendous number of opportunities, and fiscal or monetary stimulus will not help hotels, restaurants, theaters, live entertainment venues, offices, or airlines. The federal government can't own them all, and it's a question of consumer and business confidence. It's not a question of stimulus. And then until people feel comfortable going to those places again, which feels like it's going to be a bit of time, we're going to see a massive distress cycle. In this case, I would analogize it more to what happened in the early 90s, which Justin is probably not old enough to remember, but I know Glenn and I are both, as you can tell by my hairline.
I grew this facial hair just to try to match the age differential. I guess it didn't work.
I can't grow hair. That's the problem. I can't grow hair.
All right, Justin, before you weigh in and put your jabs out at Glenn and Don, I am wondering, just to follow up, Don, with respect to what Glenn was talking about returns targeting, what returns are worth your while, basically, and how much are you sort of looking for?
In residential distress, we think we should be able to generate net returns to people in the high teens, low 20s. And I believe Glenn is right in targeting. I believe you'll be able to generate mid-20s returns in commercial real estate.
Okay, and I will withhold my wish to ask you about the future of New York City as a native New Yorker. So I'm not going to go there, but that will be the next panel, hopefully, that we can have. Justin, you can weigh in.
I'd love to New Yorker, but I'm sitting in East Hampton, which tells you the problem.
Yeah, you are? Well, come back. It's not that bad. Justin, what's your take on the commercial mortgage cycle and where we are and how you play in that space?
Yeah, so I think you have two of the foremost experts on that space, in Glenn and Don, and it's not an area that we are an expert in. So I think you've heard from two of the best out there.
All right. What about returns targeting? How are you thinking about that?
Yeah, I think when you think about overall returns, and you mentioned it earlier, it's clear that in the more traditional asset classes, return profiles have to come down given where rates are, and they have come down. And you can see where yields are, whether it be investment grade or high yield. And so in order to achieve the return profiles that Amy was highlighting, you need to look to some non-traditional ways of doing that. I think that there's, from where we sit, we think convertibles continues to be able to achieve double-digit type returns, especially when you think about the technology focus of that sector, plus the downside protection that you get from it being a debt-like instrument. So we think that there's some real return profile there. And then on the other side, what we've spent most of this panel talking about, really opportunistically taking advantage of intermittent volatility. We do believe you'll be able to get double-digit returns by positioning around all of the different topics that we, I think, highlighted as a panel today. I think those are two areas if you wanted to get excess return where an investor can focus.
So we have 1 minute left. And Amy, as we talk about all this, I'd love you to wrap things up with the question, how much more risk are you willing to take to get that 7.25% return based on this idea that with this benchmark rate at all-time lows, it is very hard to do it in reliably safe instruments?
Yeah, I think there's a trade-off, obviously, between the risk and return in the market. I think we may be entering an area of the market with some significant opportunities within the debt space. We look for credit exposure, that type of volatility within our core portfolio, but also within our equity portfolio. So as we think about our return expectations, again, we're looking to a diversified portfolio of assets to deliver that over time. We think that our allocations to more opportunistic managers will be able to achieve some of the returns that my colleagues on this panel have discussed in the high teens potentially, and that this time in the market will present some unique opportunities that we haven't experienced in a while. And so we're going to be looking to those types of alternative strategies to deliver those returns to help compensate for some of the lower return expectations in that core portfolio.
I want to thank everybody. I could spend another hour, maybe two, with this tremendous panel. Glenn, Amy, Don, Justin, thank you so much.
Thank you.
Thank you.
Thank you, Amy.